You are welcome to my channel. This is Kevin Davis Accounting. Today I would like us to have a question on the income statement and the statement of financial position. So this is the question. It says the book of Caris company prepared the following trial balance as at 31st December 2023. So we have our particulars. We have cash at hand 2,000, cash at bank 4,000, land 100,000, motor vehicle. We have accumulated depreciation, equipment, accumulated depreciation as well, discount allowed. Then we have also the additional information. Now, they are saying in the additional information that you ascertain the following. The closing inventory at the end of the year was valued at 20 million Uganda shillings. Then B, salaries of Uganda shillings 2 million accrued or remained outstanding at the end of the year and were not recorded in the trial balance. C, half of the rent paid is for the forthcoming financial year. Then D, depreciate tangible non-current assets by 20% on cost at the end of the year. Then E, 20% of trade debtors are expected to default. A provision against bad debts needs to be made. Required. As the company's accountant, prepare Caris company's income statement for the year ending 31st December 2023 and a statement of financial position or the balance sheet. Now, that's how our question is. So we start by saying Caris company's income statement for the period ended 31st December 2023. Then we shall have our particulars here. We shall have our amount. Then in our amount, remember it is written under 3 zeros, then also in Uganda shillings. The same here. Then we shall have our amount still here. So it means all the amounts that they have given us in the trial balance, like you have seen in the question, they have other 3 zeros which are not seen. So we're supposed to indicate this to show that the 3 zeros are there. So now, like from our format, we said that we shall take the sales first. So we come and say sales, and they were how much? Our sales were 200,000. See? Then we have our sales returns, which is 10,000. So you say sales returns, which is 10,000. So we subtract them from our net sales. Then the figure we shall get will be our net sales, and it will be 190,000. So these are our net sales. Now we are going to look at the cost of sales, the cost of these sales. So we come and establish the value. So we shall say less cost of sales. So our cost of sales, one, we shall have the opening stock. Now, let me talk about the opening stock. Sometimes they might not tell you that it's opening stock. Sometimes they might just indicate like this, inventory 11, like this. So if they give it to you like this, it means this is opening stock, or this is stock as at 1st January. So they might just give you 11. So when they give you this, so just know that is opening stock. That's actually the difference. And so when they give it to you like this, you just bring it under opening stock. So we look at our opening stock, and our opening stock was 1,000. So we bring it here and say opening stock is 1,000 shillings. See? So after that, we come and add purchases, Remember I told you that purchases always have other adjustments before we take the final figure here, the one we shall add to the opening stock. Now, our purchases, the amount was so those are our purchases. Now, there were also purchase returns. The purchase returns, and our value of purchase returns was 5,000. So we shall subtract the 5,000. We show it in brackets to show that we are subtracting. Then we had carriage inwards. And our carriage inwards were 6,000. So we take the total. Now, that means we shall have 110,000 minus 5,000 plus the 6,000. And we shall take the total as 111,000. So when we add this plus this, we shall have 112,000 as our cost of goods available. So that means when we check in our stores, this is what we have. This is the amount we have in our stores for sale. Then we shall sell less closing stock. And our closing stock, they are telling us in the additional information, if you look back down, they say our closing stock, there was a closing stock of 20 millions. Now remember, in the additional information, they are telling us 20 millions. But remember, we have these zeros here, the 3 zeros. That means we are going to remove the 3 zeros from that 20 million. Therefore, we shall have our closing stock as 20,000. Therefore, when we take this off, and our final value will be 92,000. So we bring it here and say 92,000 as our cost of sales. So what we are going to do, we are going to deduct our net sales from our cost of sales, and the figure that we shall get will be the gross profit. Therefore, our gross profit is 98,000. That's how it is. Now, we are done with the trading account. So next, we are going to see the profit and loss account. So we are going to start with other incomes. Add other incomes. So in other incomes, I told you we have quite a lot. It can be commission received, it can be discount received, but basing on our question here, we have a discount received only. And it is 1,000. So we can bring it here. Then we get the total incomes. So these are our total incomes. So these are our total incomes. Now, from this, we are going to take off the expenses. So we come and say less operating expenses. So when it comes to operating expenses, we have quite a number. One, we have discount allowed, which is how much? It is 2,000. So we shall say discount allowed. We come here and say it is 2,000. Then we also have salaries. Actually, salaries in the additional information they had an additional information, so we're going to adjust. So we say salaries. But remember, in the additional information, they said about salaries that there are certain salaries which remained outstanding. So these salaries were worth 2 million. So we shall first get the total amount of salaries that we have, which is 8,000. Then, remember, I told you when the salaries are accrued or outstanding or due, then we add them. So we shall have our salaries outstanding. These are end year adjustments, so you put a 2,000 here. So we have a total of 10,000. So remember when I told that when an expense is outstanding, an expense is due, it means irrespective of that period, actually you are supposed to pay this amount of money. And because it is here, remember, additional information, it has not gone through the double entry system. That means we shall complete the double entry system in the statement of financial position. So we shall enter it here in the income statement as an expense, but also to become a liability when it goes to the statement of financial position. Then next we have rent, but also remember, rent, they told us that half of the rent is for the forthcoming financial year. Remember, we are not interested in the forthcoming financial year. We are interested in the financial year ending 2023, 31st December 2023. That means when it goes to 2024, we are not interested in that year. So all we need are the financial statements of this period. So that means when they tell us that rent, the actual amount was they paid 1,800, but they told us that half of this was for the forthcoming financial year. That means we shall say rent prepaid is 900. We deduct it off, then we shall have our 900 here. Remember, I told you that when an expense is prepaid, we are supposed to deduct it off because we have not yet actually utilized what? We have not yet utilized that thing or that item for that particular period. For example, if it's a house, we are paying rent. We have not yet stayed in the house for that period. So we are only looking at how much actually we incurred, not how much we paid. So if we are looking at how much we incurred actually 900, but we paid 1,800. That's the difference. Now, because we paid this, remember, I told you it has not gone through the double entry system as well, so we shall complete it in the statement of financial position. Now, any expense that is prepaid, it becomes an asset. It is a current asset. So when you go to the statement of financial position, we shall have this as a current asset because we have not yet used the rent. So we can go to the landlady or landlord and tell them, you know what, give us our money. We have not yet utilized this. So that's the difference about that. We go to our next expense. Our next expense is we have electricity. And the total amount of electricity was 7,000. So we bring here, say 7,000. Then we have depreciation. Remember, they told us that we're supposed to depreciate intangible non-current assets at 20%, and the tangible assets we have motor vehicle and equipment. Remember, I told you that land does not depreciate. So that means we are going to have depreciation. One, we have it on the motor vehicle and also equipment. So remember, the cost, I think when it comes to the cost of the motor vehicle, it was 10,000. So when you get 20% of the 10,000, actually you have 2,000. So we have 2,000 here. Then this one for the equipment, it was 20,000. So when you get 20,000 times the 20%, you have 4,000, giving us a total of 6,000 because I've combined the depreciation all together. So our next is bad debts. Now, remember they told us that we have bad debts, but they said 20% of the trade debtors are expected to default. So a provision against bad debts is supposed to be made. So that means originally we had our bad debts as 1,200. But remember they told us to make 20%, a provision for bad debts. So if we are supposed to make that 20%, actually we are supposed to add it to the bad debts. So we shall say that 20% of the 5,000 of the debtors, so the 5,000 of the debtors, it will be 1,000. So you come here and say plus 1,000 because the provision against bad debts is placed against the debtors. So if our debtors are 5,000, we are going to place the 20% on the 5,000, and so we take off this figure. Now, like I told you that this 1,000 still, when it comes to additional information, we are still supposed to complete the double entry. That means we shall go to the statement of financial position. We shall deduct this provision of 1,000 plus the provision in the trial balance as well. So that means here we shall have a total of 2,200. Then I think that's what we have. Now remember, we are supposed to take a total of this. to get our total expenses. So when we add up all this, actually we are supposed to get 28,100. 28,100. So this is the total expense that we have. Now remember, I told you first to get the net profit. Of course, we shall get the total incomes minus the total expenses that we have. Then when we do that, our net profit will be 70,900 as our net profit. Now, this amount of money that we have here, we shall take it to the statement of financial position as equity. Remember, it includes equity. So this one, we shall add it to our capital in the statement of financial position. So we are done with calculating this. So from here, we are going out to calculate the statement of financial position for this same what? For this same company called Carrie's company. So after this, I'm going to rub off this, then we are going to do another number on the statement of financial position, the part B of this. Now, we are done with our income statement. So we are going to look at the statement of financial position for Carrie's company. Now, remember I told you that at the end of the day, the statement of financial position should balance. Remember, we extract it from the accounting equation. So, being that it's an accounting equation, we are going to have two parties balancing. Remember, the assets, then the liabilities and owner's equity. So, when we are preparing the statement of financial position, of course, we shall start with our assets. And our assets shall have the non-current assets. Now, remember I told you here we shall have cost, accumulated depreciation, and also here we shall have our net book value. So, this is it. When you look at our trial balance there, we have our non-current assets. We have one we have motor vehicle. And it cost us 10,000. Now, when you look at this, when you look into the trial balance, there is an accumulated depreciation for the previous year, which is 2,000. So that means we are going to bring that accumulated depreciation of 2,000 here, but also there is that which we have calculated. Remember, in our income statement, they told us that we apply 20% on all tangible non-current assets. So that means also that 2,000 will be bought here. Now, it means we shall have 2,000, which was for the previous year, plus the 2,000 that we have also calculated, giving us a rise of 4,000. So we indicate that we're going to subtract this. Then we bring the figure here as 6,000 as the net book value, meaning that our car, actually this motor vehicle, if someone has to buy it, this is the amount of money that it's worth. This is its fair value as it is right now. Then we continue now. Next we have land. Our land was worth 100,000. Like I told you, land does not depreciate, so we just leave it there and we bring the total figure this side. Then next we have equipment. If you look closely to our trial balance, equipment was worth 20,000. But then also there is depreciation of the equipment. Depreciation of the equipment in the trial balance before the adjustment. So the depreciation in the trial balance is worth 4,000, right? So if it's worth 4,000, and also the one we calculated, also remember we applied the 20% here. It also gave rise to 4,000 as well. That means we shall have that 4,000 plus the 4,000 of depreciation of this year. Then we shall have 8,000. So we show that we are going to subtract it off and we bring a total of 12,000 here. So we are going to take here the total, and the value is 118,000. This is the value of our non-current assets. Then we have our current assets here. So our current assets, one, the inventory. Remember, we have two types of stock in our trial balance and the general information. We have the opening stock and we have the closing stock. But remember, we say that our statement of financial position is as at 31st December. So if it is as at, that means we are going to take the closing stock. So we come here and say our closing stock. So we just indicate stock. Then we come here and say it was worth 20,000. So like that. Now when you check in our trial balance, still we have cash at hand and cash at bank. Now cash at hand, remember it is also stock. It is worth 2,000. We have cash at bank. It is worth 4,000 as well. So this is how we are supposed to prepare the statement of financial position. Now we have also, remember we talked about the debtors. So these are trade receivables or debtors. Now the trade receivables, the actual amount was 5,000 if you look close in the trial balance. But then they told us that, remember, there was a provision against bad debts in the trial balance as well. So if there's that provision against bad debts, we are supposed to deduct it from the trade receivables. But now we have also calculated another this provision for bad debts. So it means we shall come and say less provision for bad debts. And we are going to say it is 1,000, the one you have calculated, plus the 2,000 in the what? In the trial balance. Then we shall have a total of 3,000 here. Meaning 5,000 minus this 3,000, we shall give rise to 2,000. That's how it's supposed to be done. Then there's something I talked about when we were calculating the income statement. Remember we had the rent prepaid. Now a rent prepaid, remember I told you it's a current asset. So we bring it here and we say rent prepaid, and shall indicate the value as 900. So that's what we have there as our income statement. Then the total value when we add here, it will be 28,900. Now when we add this plus this, we are going to get our total assets. So our total assets, we shall have 146,900. Now this value that we have got here, when we calculate down, remember I told you our accounting equations like assets equals to liabilities plus owner's equity. Now we are done with calculating for the assets. That means we are heading to this section where we are going to calculate for the liabilities and owner's equity. So the value that we have got here should be the same value that we shall get down here when we calculate for liabilities and owner's equity. So let's see how it's going to go. Then we come here and say, let me start with owner's capital, owner's equity. So when we get owner's equity, of course we have capital, and our capital was 26,000. 26,000, you can see there. We don't have drawings. If we had drawings, we would have subtracted them here. But now, remember, I told you that the net profit that we shall get in the income statement will go to the equity section in the statement of financial position. So we come here and we say our net profit, which was 7,900. So we also added there. And we are going to get the total here, and our total is, we shall get 96,900. You see? Then we come, we say we have our liabilities too. Now we have current liabilities, and these are current liabilities. We have one, we have the trade payables or creditors, and our trade payables were worth 3,000. 3,000, we bring them here. 3,000. Now remember, when we talked about the salaries accrued. Remember, we saw that in the statement, the income statement, we had salaries accrued too. Now the salaries accrued in the income statement, they were worth 17,000, but those ones, remember, like I told you, they were in the trial balance. So in the trial balance, when an item appears in the trial balance, it means it has already gone through the Dow entry system. So when we come here, we shall say salaries accrued. Remember, we had two kinds of salaries accrued. One was in the trial balance, which was 17,000. That means that one was for the previous year. So even this year, we still had salaries accrued, or which remain outstanding. So when we calculate that, we shall also have our salaries accrued as, remember, the one that was in the trial balance was 15,000. Then plus the one that we calculated, which was 2,000. So this will give us a total of 17,000. That's how we're supposed to do that. Then we have our long-term liabilities. Now, when it comes to long-term liabilities, when you look in the trial balance, we have a long-term loan. Now, that long-term loan becomes a long-term liability. So we come here and say our long-term loan. Now, the long-term loan was worth 30,000. So we bring here 30,000. So when you add this, this is 20,000, this is 50,000. Now, when we add our 50,000 to this, we realize that we have a total of 146,900. So, therefore, our statement of financial position has balanced, and this is total owner's equity and liabilities. Meaning, our statement of financial position has balanced, meaning we entered all our entries right in the income statement, and so it means all our businesses, this is how it's functioning. So if it didn't balance, that means we made them an error somewhere. So we go back and trace for the error. In fact, sometimes we prepare the statement of financial position to trace certain errors. Also, you can find out whether there was some manipulation of money or what, so something of the sort. And also, we prepare this statement of financial position also to check on the business performance, on the performance of the business. So we have calculated our statement of financial position and it has duly balanced, like you can see here. So that's how it is calculated. Thank you so much for watching. This is Kevin Davis Accounting. Share to your friends, subscribe, hit on the bell button so that you can get more videos when I upload. It's a bye for now.